All right. I want to thank everybody for joining today. And thank you for taking the time out of your day to go over some retirement saving strategies. Also some ways to minimize your taxes. And for those of you on the call today, if you have any further questions, feel free to reach out to me. The presentation here will be about 25 to 30 minutes, and then we'll jump off. If there are follow-up questions, I've got my contact information on the last slide to where you can reach out to me and ask me any sort of questions that you may have. So I'll go ahead and get started today. Like I said, if you've got questions, write them down. You can ping me, shoot me a note on any of the information that comes up. There'll also be, some follow-up information or some call to actions here as well that I'll show you throughout the presentation. But without further ado, I'll go ahead and jump in here. So first and foremost, just a quick disclosure slide. So the information here is educational in nature. It's not to be taken as custom or specific advice to your situation, just more so general and educational in nature. If you want a customized plan, reach out to me and we can talk on an individual basis. So to set the scene here, so why are we talking about retirement savings today? What are some of the benchmarks that are out there? What are we noticing about working with clients? And then in general, where people are at from a retirement savings standpoint. So first and foremost, retirement is longer. So people are living longer or they're retiring earlier, and they're doing more throughout retirement. So in the past, the old adage was, why did they set Social Security at the age of 62? And it's because in the past, that was people's life expectancy. So people were dying around the age of 62. So that's why they set security up at that age, at 62. The government did that as a little trick to not have to pay people for their Social Security. But now, as you can see, life expectancies, people are living longer, longevity's on our side, health developments. So people are living longer, and one of the risks that we run is that their savings aren't keeping up. Also, Social Security, which in the past was meant to fund people's retirement expenses, now we see it only makes up about a third of the income that people may need in retirement. So just on average for people age 55 to 64, average retirement account balance is about $197,322. That was as of 2020. Average monthly Social Security benefit is coming in at $1,534. And then medical expenses. So what are some of the average costs of medical expenses that we're seeing out there? And for a married couple, in order to have enough medical expenses funded, they need to have at least $270,000 saved that they can allocate towards medical expenses in retirement. So these are, like we're throwing out here, these are our national averages. Obviously that account balance of about 197,000 for people ages 55 to 64, quite frankly, is not going to be enough for someone to fund a full retirement age. Because as you can see here, Morningstar studies. So if you are looking to retire and generate at least $40,000 a year in income. So if that's what you need to pull from retirement is $40,000 every year, what amount do you need to have saved, accounting for an average annual return of 6% and inflation at 2.5%? It's saying you'll need at least $1.18 million saved towards retirement in order for you to generate $40,000 of income over a 30-year retirement period. So that's one kind of rule of thumb. It's, hey, how much did you have saved? Well, if you need 40,000 from this account, from your retirement savings, plus your Social Security income. So if your Social Security income plus the income that you can withdraw from your retirement accounts, whatever those two numbers are, if that meets your income level, then great, then you're in a good spot. If you need to pull more than 40,000 out, then obviously that number goes up. That 1.18 million goes up, and you're going to need a higher account balance there. The other variable in that equation there that you see on your screen is inflation. So, historically, inflation's been around 2.5%. Right now, that's not the case. As you can see, the July, the July reading and the August reading, I mean, we're closer to an 8 to 9% inflation rate right now for this year. Obviously, the Federal Reserve, as you can see today, announcing about a 0.75% interest rate increase. They're trying to get that inflation number under control. That's their main focus for this year, trying to get it back down to around that 2.5% range. But who knows? That's obviously going to take a while from what we've seen so far this year. So things that we'll talk about today, catching up on retirement savings. So what are some things that you can do now if you are, age 50 and above, and you're trying to boost your retirement savings, get more money tucked away so that you can have a comfortable retirement? So there's certain things you can do. One of them is the IRS catch-up. And then obviously the importance of using these strategies. We'll also talk about health savings accounts and the tax benefits that are involved with those, evaluating your situation. So what are some things that you need to look at? What are some things that you can pinpoint now as you might be closer to retirement that can give you a good indication of where you stand and what you may need to improve? And then kind of mapping out your plan. So what are some action items that you could take today that'll help you to map out where you're at in the future and help you to get to those goals? So the IRS catch-up plan. So these are for investors that are over the age of 50 and up. And typically the rule of thumb, if you listen to a lot of the financial talking heads, you listen to somebody like Dave Ramsey, they want you to be contributing and saving at least 15% of your income going towards retirement savings. That also includes, within that 15%, that includes any sort of company match that you're getting on your savings. However, once you reach age 50, if you have not been saving at least that 15% every year, going towards your retirement savings, when you reach age 50, that's when you should really start to max out. So at age 50, if you feel like you're behind, it's a good time to start to max out your plans. So that does not, when we use the term maxing out, that does not mean maxing out so you're getting the full company match. That means putting in the total allowable amount that the IRS will allow you to put in on a year in and year out basis. So if you're saving into a company 401k plan, the annual maximum amount that you can put in is $20,500. That's as of the year 2022 that we're currently in. We are expecting that number to go up for 2023, but for this year right now in a 401k plan, you can put in $20,500. If your company offers a simple IRA plan, so within a simple IRA, the maximum amount that you can put into that plan is $14,000. So both of those numbers, that $20,500 and the $14,000, are increases from last year. So those numbers have both gone up by $1,000. So if you were used to having a different maximum amount, just know that for 2022, that number is higher. Then in addition to that maximum amount, if you are over the age of 50, you can put in that catch-up contribution. So if you're over the age of 50 and you're in a 401k plan, that maximum contribution, that catch-up contribution amount is $6,500. So if you're doing the math and you're saving into a company 401k plan, you can put in $27,000 if you're over the age of 50. That $27,000 does not include the employer match. So any sort of employer match, employer profit sharing would be on top of that $27,000. So if your company, if they match a certain amount of your income, they can put in an additional $5,000, $10,000, whatever that amount is, because the total amount that they could put in for 1 year, including your contributions plus your company contributions, comes into around, if you're over the age of 50, around $62,000 total. So you can max out your plan and still get that company match on top of what you're putting in when you're saving into a 401k plan. If you're in a simple IRA, your catch-up contribution amount is $3,000. So again, just like a 401k, you can put in that $17,000 total if you're over the age of 50, and then your company match would be on top of that. So for most simple IRA plans, they match at 3%. Some simple IRA plans match at 2%. But if your company matches 3% on your simple IRA plan, that would be in addition to your $17,000 that you can put in. So those are the maximum amounts. Again, keep in mind, your company match would be on top of these amounts, would be in addition to what you see on your screen. So the importance of maxing out. So if you look at these different contribution amounts that you see on your screen on the right there, what those different dollar amounts could mean for you as you're maxing out your contributions. So if you were doing, if you look at this over a 15-year time period, this is assuming a 6% return. If you're reaching the full 401k contribution of $20,500, you could see the amounts that these would grow to over a 15-year time period. So by taking advantage of the catch-up contributions, by just doing that catch-up amount alone, so again, in the 401k plan, that's $6,500 catch-up contribution, you would get an additional $160,000 added onto your account balance by doing the catch-up contribution in a 401k plan. So these amounts show you, the different amounts of money that you'd have saved over that 15-year time period. So if you're saving $5,000 every year, you'd have about $123,362 after 15 years. $10,000, you'd be at $246,000. $15,000, you'd be up to about $370,000, and so on. So it's important to put as much money away as you can in your earlier years. But if you haven't done that and you're over the age of 50 now is when you can do those catch-up contributions to try to make up for that lost time. So as you can see here, just a quick example, maxing out their contributions for 15 years, Jim and Paula here, a married couple, you could see their retirement savings by maxing out their 401k contributions. If they're able to do that as a married couple and they're both maxing these out, so that would be a combined $52,000 a year, assuming a 6% return. After 15 years, they'd be able to accumulate about $2.3 million in their 401k plan. So quick case study there. So taxes, so the tax impact by doing this. So every dollar that you contribute into your 401k or into your simple IRA plan for that year is basically a tax deduction. So it's reducing your taxable amount that you would get for that current year. So contributions are made for pre-tax dollars. That's lowering your taxable income for that year. That money's placed into your retirement account and it grows tax deferred. So each and every year that you've contribute, and as you're earning money, you're not taxed in that year, those taxes are deferred to a later date. And the main strategy or main philosophy for this is, as you're working, it's estimating that your salary, your annual income is going to be much higher in your working years. So ages, and especially later on in your career, so ages 50, maybe if you retire at 65, you're going to be earning a lot more during those time periods than when you are once you enter into retirement. So money comes in, you get a tax deduction for that. The money's invested, it grows, as you can see there from the chart we showed on the earlier slides. That money's going to grow for you as long as you hold it in those accounts over an extended period of time. Obviously, this year, exception to the norm with the S&P down the way that it is currently for this year. But over the long term, if you look at the averages, 20, 30-year time period, you're averaging anywhere from 6 on the low end to, if you're an aggressive portfolio, maybe as high as 10% average annual return. All of those returns, all of that accumulation is tax deferred. So then when you start to take that money out, you're taking that out at a lower income tax bracket than you would be while you're working. So you're taking that money out of your account and you are getting that money out at a lower rate. So Tax benefits, you're lowering your taxable income for the 401k contribution. Also, as you can see, depending on what tax bracket you fall into, since your 401k contributions are going in on your gross pay, it's not a dollar for dollar reduction in your net take home pay. So depending on what your tax bracket is, if you're putting in this example here, if you're putting in $100 per paycheck, the net income amount on that, it's more so a $60 to $80 reduction in your net take home pay. So $100 contribution into your retirement plan doesn't necessarily mean $100 reduction in your net take home pay. It's more so it's closer to that $60 to $80 reduction in your net take home pay. So that's where I highly encourage people, bumping your contribution rates up by a little bit more. If it's $100 a paycheck, or if it's 1 or 2%, you don't see a huge decrease in your net take home pay by boosting your contributions up 1 or 2%, or even $100 per paycheck. You don't see a huge negative in your net take home pay. So looking at the numbers, if you were to max out your 401k contribution, and this is using the $26,000 amount, that was 2021's maximum contribution amount. So if you were to max out your 401k contributions at $26,000 per year, what that looks at is, okay, what are you saving in taxable? So the first example here, if someone made no 401k contributions, and their payable tax, if they're in the 24% tax bracket, they're paying an effective tax rate of about 18% on that $150,000 of gross income. However, if they were to max out their 401k plan and their income still puts them in the marginal tax bracket of 24%, their effective tax rate drops to 16.75%. So they saved $6,240 by maxing out their 401k. They save that $6,240 in that year in taxes paid. So just a quick kind of a simple example of, by maxing out your 401k contributions compared to someone that's not making 401k contributions, how much money you can save in the actual amount of taxes paid each year. So one quick thing that I wanted to add in here and wanted to discuss, it's a bit of a caveat, it's a bit of a loophole for some 401k plans. And it's a way that you can actually boost your retirement savings. So as I mentioned before, kind of the total gross amount that you can put into a company 401k plan, when you include your contributions plus employer contributions, can boost all the way up to that $62,000 amount. That is all on a pre-tax basis. So if you're over the age of 50 and you max out your contributions plus the catch-up contributions into a 401k plan, so you max out at $27,000. Let's say your employer match, they throw in another $10,000. So now you're putting in $37,000 into your 401k plan. One of the things that you can do if your company 401k plan allows it, and this is what I stress with many business owners that have a 401k plan, to add a loophole of allowing their employees and the owners of the company to make post-tax contributions. So an after-tax contribution amount. So what that does is you max out your pre-tax contributions at $27,000. Your company matches their pre-tax amounts as well for additional $10,000. Now you have potentially another $20,000 or so that you can save into a 401k plan. And you can do this by using after-tax money. So you don't get the tax benefits of reducing your current income, but you can put after-tax money into a 401k plan. So what happens with that money once you do retire, the contributions that you put in are not taxed, but you get tax deferred earnings on that additional money. And it's a way that you can, and if you do that over a course of years, so let's say you do that over a 10-year time period, you're putting $20,000 a year after tax money into your 401k plan. Then when you go to retire, you can take that contribution amount that you put in. So that $20,000 over 10 years. So you're looking at $200,000. You can immediately take that after-tax dollar amount and you can convert that into a Roth IRA. So a lot of people call this the mega backdoor Roth funding contributions. So that is one way that you can get exponential Roth contributions within your company 401k plan and do that without reducing you to the maximum amount of $7,000 that you can do as a backdoor Roth contribution amount. This is where you could take that same after-tax money, put it into a 401k plan. Then once you go to retire, open up a Roth IRA and do a mega backdoor Roth contribution at the time that you retire. So you can take that $200,000 that you've already paid taxes on, fund that into a Roth, and then that Roth can grow exponentially with that large post-tax contribution that you've made. So you could take those post-tax contributions, put that into a Roth. The earnings on those after-tax dollars would stay in the 401k plan. They'd stay as pre-tax dollars. So eventually they'd get taxed at ordinary income level. But that would, again, that would just be on the earnings that you've earned from those after-tax money. So it's a bit of a complex strategy, but it's a great way for high income earners, for business owners, that they can fund a mega backdoor Roth contribution at the time that they retire. So switching gears here to HSA, so health savings accounts and some of the benefits for these. So health savings accounts are a great way. It's a great tax advantage strategy to boost your retirement savings. So as I showed you on the slide before, you may need, if you're a married couple, you may need as much as $270,000 towards medical expenses throughout a 30-year retirement period. So an HSA is a great way to fund that because HSAs are triple tax advantage. So every dollar that you put into an HSA plan, similar to a pre-tax 401k contribution, every dollar you put into an HSA goes in as a pre-tax dollar. So it's reducing your current income for that year. It goes in on a pre-tax basis, goes into the HSA account. Any interest that money earns, or if you invest that money, any earnings that you have from those investments grows tax deferred. So you're not taxed in the year that you're earning those returns. Then withdrawals that you're taking out of the 401k, the third tax advantage of this, all of that money that you're taking out of the HSA, if as long as you're using it towards medical expenses, you are not taxed on any of those dollars. So you get a tax deduction when you put that money in. That's the first advantage. That money grows tax deferred. That's the second tax advantage. Then when you take the money out, apply it towards medical expenses, that's tax free. So that's your third tax advantage when you're working with a health savings account or an HSA. So again, if you have some extra income and you're over the age of 50, it's a great time to start to look to set up a health savings account, put as much money that you can into that, and hopefully that will then can cover your medical expenses throughout your retirement. So what are the rules around these? So with an HSA, obviously you need to be into you've got to be saving into a high deductible healthcare plan. And some of the rules, the contribution limits for these, if you're on a family health insurance plan, you can contribute as much as $7,300 into an HSA plan for the year 2022. For individuals, they can contribute up to $3,650. Again, that was also an increase from the year 2021 to the year 2022. And then they also have a catch-up contribution for an HSA. So if you're over the age of 55, you can contribute an additional $1,000 on top of that $7,300 if you're in a family plan, and on top of that $3,650 if you're in an individual plan. So a couple of things that the HSA can cover. So the HSA can be used in the year. So you can put $7,000 into an HSA and you can use it in that same year if you needed to. If you did that, you're obviously not investing the money, so that money's not growing tax deferred, but you're paying all your medical expenses with pre-tax dollars. So if you're in the 24% tax bracket, automatically you get a 24% savings on all of your medical expenses. Or if you're in a position where you want to fund your medical expenses out of pocket for that year and let that money grow, you can carry these forward year after year, just like you would with any sort of retirement account, any sort of IRA, any sort of 401k. You can keep that money in there, let that money grow, and use it towards future expenses. So one of the advantages of this is you can use it to pay your deductibles for any sort of co-insurance, any sort of prescription drugs that you may be on, vision and dental care. So it covers all of those medical expenses that can be paid for and used out of your HSA each and every year that you have that. So HSA plan, if your company offers it, make sure you're taking advantage of it. If you're a business owner, could be something to look into starting for your company if they currently don't have one today. So like I talked about, triple tax advantages of the HSA, growth through investing. So some of the plans that you have, some of the HSA plans, they might require you to have $1,000 in there in cash before they allow you to start investing that money. So anything in addition to that $1,000 can be used to invest. But make sure that you're looking at it. If you have the option to invest that money in the HSA and you're saving, you're going to use those funds for the long term. Make sure that you take advantage of the investment options that you're in there. All right. So last part today, evaluating your situation. So what are some things that you should look for as you're nearing retirement? If you're in that 5 to 10 year or even 15-year window of retirement, you should pretty much have a good idea of what you're going to be spending. So current income, it might fluctuate. It might have fluctuated earlier on in your career. As you're reaching retirement, that might be more of a set number, and you can really get a good gauge on what your current income is. Look at your current savings rates. If you have the opportunity to max out and save more, then make sure you're taking advantage of that. Again, I think the contribution limits are going to go up even higher in 2023. I think we're going to see another boost into those. So make sure that your current savings rates, if you thought you were maxing out your plan in 2021, obviously you can go higher in 2022 by the additional maximum that they gave you. I think they're going to go up even higher in 2023. So keep an eye on that. Your current savings rate, making sure that you're putting in as much as you can if you feel like you're behind. Current assets. So, looking at your balance sheet. So the two parts here, the current assets and any debts that you have, make sure you've got a good grasp on your net worth. So where do your assets sit compared to your liabilities? If there's some things that you can pay off and that will help you feel better entering into retirement to not have those fixed expenses, go ahead and try to do that. One of the big questions I get is, should you pay off your mortgage before entering into retirement? For a lot of people, typically the word of advice that I use for that is, if you think you're going to stay in that same home all throughout retirement and you want to just eliminate your monthly expenses, reduce those by as much as you can, then I'd say, yes, go ahead and pay that amount off. However, if you look at current interest rates, for some of you, your home mortgage might be 2.5% to 3.5% right now, whereas new mortgages on a 30-year might be as high as 6%. With the rate increase today, it could be even higher than that the next time you look. So if you're planning to move in retirement and maybe not stay in that current home, then you may not want to pay that off because you're going to be selling, you're going to be cashing that money out anyway. So there's really no silver bullet for that on if you should pay your mortgage off in retirement. It's a question I get a lot. And a lot of it is how comfortable are you with having debt? If that'll help you sleep better at night and it reduces your current income, then go ahead and pay it off. If not, if there's ways that you could potentially get a higher return than what you're paying in interest, then mathematically, it wouldn't make sense to pay that off. It would make sense to keep that mortgage rate where it's at. So annual expenses, this is another thing that, if you're 55 and older, you should have a pretty good grasp on what your annual expenses are, what you're spending on an annual basis, and make sure you break that down into a monthly basis and see, okay, if I stop my income, if I turn this lever off, I'm no longer getting a paycheck. How am I going to meet those expense needs that I have? So what buckets of money, what investment holdings, what savings accounts, what retirement accounts, plus your Social Security, how are you going to meet the needs for your monthly or annual expenses? How will those expenses be covered? And you should narrow down and really start to look at, okay, what are we spending on a monthly basis? Investment holdings. So what's important to remember with these is you should be rebalancing over time. So as you start off in your career, the farther you are away from retirement, you want to be invested more aggressively. As you start to get closer and closer to retirement, that's when you can scale back the risk, take a little bit of risk off the table, make sure you have that money preserved. Because when you're looking at your retirement savings, at your investment holdings, the money that you're going to need in the near term, call it 12 months, you want that money to be invested in cash or cash equivalents, maybe short-term CDs, short-term treasury bonds, things like that, that you know that money is going to be easily accessible to you once you're retired and you need to start withdrawing those funds. So look at your asset allocation. Make sure you've got it structured in a laddered strategy. Here's what money I'm going to pull from in the first 12 months. Here's the money I can pull from over 18 months to maybe up to 5 years. That money should be conservative. That money should be invested in either big blue chip companies that pay a good dividend, or things like bonds, short-term bonds, municipal bonds, treasury bonds, things like that, that can make that money more conservative. Long-term money you won't be using for 10, 15 years. That's what you can look to try to get a higher return, invest that more for growth. So that way, as you're withdrawing your money, you can use that growth to start to replenish those buckets of money that you're pulling from. So these are all things that you should look to consider as you're preparing for retirement. Those 6 things really start to hone in on, know your numbers, know where things stand, and know how well you're prepared for retirement. Last thing is, it's kind of the great unknown, is your medical expenses. So medical cost. If you were to get off of your company health insurance plan, what will be your new medical expenses? Are there certain prescriptions that are covered by your insurance that if you get on a private insurance plan, they may not be? How much in premiums are you still going to have to pay? Even when you go on Medicare, you're still going to owe your premiums for that. And that could be as much as $5,100 to $5,200 potentially in Medicare premiums when you enter retirement. So there will still be Medicare costs if you're on certain prescription drugs, if things like vision care, dental care, those things you have to get supplemental Medicare plans for. So prescription drugs is Part D for Medicare insurance. Make sure that you have a good estimate of what those costs are going to be. And that's something that you should sit down with your advisor on and really try to nail down. Okay, what are the coverages that we're getting now? If I retire, if I sell my business, I'll no longer be covered under, and how much are those expenses going to be? So those are, lastly, there's medical costs. Make sure you kind of hone in on those and you have a good estimate for that. So mapping out next steps, like we talked about, kind of taking inventory of those 6 things. Where are you at today? Also, lastly, run a Social Security, pull a Social Security statement. ssa.gov.gov is the website. They no longer, for most people at least, they no longer mail you those Social Security statements. Go to ssa.gov, create your login, find out what your Social Security amounts will be at retirement. And then you'll want to analyze, when should you start taking those? Is it 62, which for most people, I advise against taking it right away. Is it 65? Because that's when you're eligible for Medicare. Or is it better to wait till your full retirement age, which may be 66 in a few months, or for other people might be 67? What's the advantage of doing that? Does it make more sense to delay your Social Security? Certain factors to look at: longevity, medical history. The longer you live, the more it makes sense to let that Social Security amount grow, because it's going to grow at an 8% rate. It's going to increase at an 8% rate for every year that you do not claim your Social Security. So if you've got longevity on your side, it might make sense to wait until age 70 and get the highest monthly income amount in doing so. So those are certain rules of thumb. Again, log into ssa.gov. You require your Social Security number, pull your most recent Social Security statement. Required minimum distributions. So we talked about putting as much money you can into your retirement plans, putting those pre-tax dollars in. When you reach age 72, you're going to be required to take that money out. So you're going to be required to take that money out. And the reason being is the IRS wants their tax money on that. So the IRS wants their taxes, so they require you to start taking money out. That required minimum distribution amount, it's a formula, and it's based off of your account balance at the end of the prior year. Plus, and they take that amount, they divide it by a life expectancy divisor. So in your first couple of years, it might be 3.5 to 3.6%, and it slowly increases each year. So you slowly have to take out more and more money. And if your account continues to grow, that annual amount, that required minimum distribution amount, will then grow over time. So something to consider. I'm happy to run projections for you, and I can kind of see what your required minimum distribution amounts will be. So those are other two factors to consider in addition to those 6 things that I laid out on the slide before. So the bottom line, catching up on retirement savings is possible. So there's steps that you can take to start to do that. And those are the strategies that I laid out earlier. And it's a great idea to do so if you feel like you're behind. So how can we help? How can Amy and I help? So feel free, call the office line there, that 513-709-0004. You can shoot me an email. I'm happy to set up time with you to review, to maybe refresh your financial plan, looking at, and now's a good time to do that with the volatility that we've seen in the stock market, with where your account balances may be compared to what we maybe thought they would be at this time period. Now's a good time to review your plan, look at things, make sure you're still on track. So give us a call, shoot me an email. Happy to set up some time to meet with you. So I appreciate everybody joining today. That concludes the presentation. And again, if you have further questions, feel free to reach out to us. Thanks. Have a great day.